All right, so this is my update on the markets. We kind of had a very exciting, it's probably the best word for it, September. First down month that we've had in the market in a long time, and that got a lot of people spooked. And some of the big worries that I'm hearing from you guys is that, you know, you're worried about inflation, you're worried about overall debt levels. And so kind of what I want to give you an overview of is what the returns we've been seeing on the portfolio this year so far, and then specifically in September. I also want to give you an idea about how I see current levels of inflation and expectations for inflation and US debt. And then lastly, I'll give you an idea of what we're planning right now as our investment strategy going forward to protect against the things that I'm most worried about. So a quick update on returns. Now, one thing important is I'm going to show you returns for our different model portfolios that we use for all of you, okay? Your individual returns will very likely be different than these returns because of cash flows and individual trades and things like that, all right? So do not rely on these returns as your individual performance, but this does give you an idea about what our portfolios have been up to. Okay, so the three portfolios that I'm showing today are our growth portfolio. Typically, we use this portfolio for clients who still have about a 10-year plus time horizon before they're going to be using the money. Okay, or there's some segment of their portfolio that we've separated out as a long-term investment. That portfolio this year is up about 9.55% on an after-fee basis. But in September, we saw a pullback of about 3%. Okay, so if you were in our growth portfolio, September may have been a little bit of a painful month, down about 3% if you're just looking at that 1 month. But still, year to date, returns are well above expectations, and I'm still very, very happy with that performance. Most of my clients, though, are invested in our growth and income portfolio, which we typically use for clients who are either already retired or very close to retirement. It's a much more balanced portfolio with less risk, a little bit less growth expectation. Even despite a drop of 2.75% in September, that portfolio is still up over 7% year to date. Okay, so perfectly on target with our long-term expectations for that particular type of balanced risk-reward investment. My most conservative portfolio that I use for my clients is my income portfolio. Year to date, up over 5.5%, did see about a 2.5% pullback in September. All right, so all three of these portfolios still very much on track. The big question, though, that everybody's asking, and that I'm asking also, is September the beginning of something bigger, or is September just a small correction, right? Some bringing back to reality from a market that's had really high speculation for a long time, okay? And that's what I'm going to try and give you an idea of what I'm looking at to try and answer that question. So the first big worry on all of your minds and really on everybody's minds right now is inflation. Okay, we've been getting some really ugly inflation data coming out recently. You know, inflation of 5% or 6% or 7% year over year. Okay, now of course the big issue is that comparing year over year is a really bad measurement. Okay, because if you're just looking at year over year, everything is flashing red. Okay, all the dials are flashing red. You know, CPI, which is the overall consumer price index, you know, is showing about 5% year over year inflation. Core CPI, okay, about 4%. The personal consumption expenditures, which tries to bring inflation down to like a household level, you know, around 4%, and then core PCE also around 3%. All of those are like triple to quadruple the 10-year average, which has only been like 1%. Okay, so over the last 10 years, all of these measures of inflation have been extremely low. Okay, 1% or less, and then this month, bam, flashes like a big red stop sign, right? That inflation is really high. Okay, and so the question is this just a blip because we're comparing a really ugly 12-month period? or is this an indication of higher inflation to come? I do not think this is an indication of higher inflation to come, okay? At least not any type of inflation that would make me worried for any of your financial stability, okay? The Fed target for inflation is about 2%. I don't think they're going to hit that. Okay, I don't think we're going to keep inflation down to about 2%. But let me kind of give you an idea about what we've seen in the past with inflation, because it might give us an idea about what we're likely to see going forward. This is a chart of inflation rates in the US by decade. Okay, so you can see all the way back to I guess kind of the second decade of the 1900s, where inflation was very high, and then during the 20s and 30s, it was extremely low. During the Great Depression, we actually had deflation, right? Then coming out of World War II, the 40s, 50s, 60s, and 40s, 50s, and 60s, we had much more moderate inflation, anywhere between 5% and 2% or so. Okay, then we had the ugly Carter years, right, where inflation was extremely high. Okay, as a decade, though, inflation still only averaged about 7%, even though I know all of you guys remember inflation in the teens. Okay, as an entire average decade, we're still only seeing inflation during that period of about 7%. Started going down in the 80s, down to 5 to 6%, and then we've had this really sweet period of time where inflation has averaged somewhere between 2 and 4%. Okay, that is a really good long-term range. Okay, it keeps prices increasing moderately. Okay, but not at a pace that really diminishes any clients who are in your situation, diminishes any of your real standard of living. Okay, so right now, if we pop up to inflation of 4 to 5%, that's high, but still not dangerous high. Okay, matter of fact, I'm comfortable if we even went through a period where we had inflation of upwards of 6 to 7% for up to 5 years. I'm still comfortable with all of you being able to maintain your standard of living, because the portfolio is designed to keep up with inflation rates of around that range. Okay, that's what we've tested against previous historical periods where inflation was running through that range. Okay, and all of our projections show that you guys are on track for a solid, comfortable retirement. Okay, with inflation pushing 6 to 7% for up to 5 years. Now, if it goes longer than that, that does start to put your real purchasing power in jeopardy. Okay, but if we have a 1 year, 2 year, 3 year period, 4 to 5% inflation, that's more like normal than it is scary dangerous. Okay. And then this chart here just kind of goes a little more granular, shows you the actual inflation rate year to year. And again, you're kind of really looking at that sweet spot, that sweet spot of kind of, the 3 to 4% inflation, over the last few decades, which have been really good for the economy overall. Okay, so US debt, right? The big argument is, well, John, because of all this US debt, it's going to drive high inflation. Okay, I do not buy that argument at all, and I want to show you why. Okay, all right, this chart, there's a lot going on, so stay with me. I'm going to kind of walk you through it. Okay, the red bars that are increasing every year from 1994 to date, those red bars represent total US debt. Okay, so if you go all the way back to 1994, total US debt was just under 5 trillion. Okay, all the way fast forward to today, total US debt 27 trillion. That's a huge increase, right? 5 trillion of debt to 27 trillion of debt since 1994 to 2020. Okay, now measured against that chart is the increase in GDP, okay, the gross domestic product for the US, which you can see in 1994 started off at about 7 trillion, okay, peaked before the coronavirus recession at over 20 trillion, and now sits just under 20 trillion. Okay, so yes, US debt increased a huge amount, okay? GDP also increased a lot, not nearly as many times as the debt did, but GDP also went up, okay? The one thing I've added to this chart, which you can see in the red boxes, is the amount of interest expense on that debt, okay? Because it's not just about debt, right? Debt is a factor of how much you have to pay in interest, all right? And so our interest expense on our debt in 1994 was $250 billion. Our interest expense today on our debt is $500 billion, okay? So even though the overall level of debt went up over fivefold, from 5 trillion to over 27 trillion, it went up fivefold, the expense on debt only doubled, okay? And so to put that in a kind of a real terms, because these numbers are so big, none of us can wrap our arms around them, okay? And so what I want to show you is kind of in real terms what how you can kind of make that a little bit more personal. Okay, I just want to make sure, I'm going to check real quick and make sure I don't need to let anybody, additional people into the meeting. It looks like we're good. All right. Okay, so let's bring all these numbers down to something we can actually relate to, okay? We're going to pretend like our country is a person who is buying a home, all right? And if I take all those numbers and I reduce them down to numbers that we can wrap our arms around, we could kind of imagine that our country was a person buying a home in 1994, okay? And in 1994, our country was earning $70,000 per year, all right? Which is akin to our GDP. They bought a home with a mortgage of about $50,000, and they borrowed that mortgage at 7.5%. Their payment was $210 a month, okay? Clearly, I think most of you would agree, if you're making $70,000 a year and your payment is $210 a month, you're doing pretty good. Now, of course, you know, you have other expenses in your life, right? But nobody would think that is overextending, okay? Now, that same person, our country, right, now in 2021, their income has gone up a lot, right? Their income's increased from $70,000 a year to $190,000 per year, okay? But our country now, with a higher earnings, has decided, I can afford a little bit bigger, nicer house. So I'm going to get a new mortgage for $270,000, but I get to borrow it at 1.5%. And my payments are only $420 a month. So now I'm making $190,000 a year, and I'm spending $420,000 a month on housing. Would you agree that this borrow is probably not overextended? I think you would. And I know certainly all mortgage companies would agree they're, you know, based on mortgage qualifications, they're not overextended. Okay, so when I look at our country as a secure, reliable borrower on the world stage, okay, I am not seeing huge overextension here, okay? Now, it's a little bit of a stretch to compare our country's finances to a household. It's actually much more akin to a business, because GDP isn't exactly the same as income. GDP is more like EBITDA in a business that then has, you know, expenses deducted. But I still think it's a relatively good comparison to make these numbers a little bit more real, okay? So really, for these reasons, I am not one who believes that our debt is incredibly out of control. I don't believe that it's going to crash the US dollar, and I certainly don't believe any other currency, including Bitcoin, is going to replace the US dollar as the reserve currency in the US. I think the US is still an incredibly stable borrower on the world stage. And our low interest rates reflect a global view that it is still the safest investment around. Okay, so I've kind of told you that I'm not too worried about inflation. I'm not too worried about debt. So what am I worried about? Okay, and what is our investment strategy going forward based on that? Okay, so here is this is actually the wrong slide. Oops. Okay, so here's what I am worried about, okay? I'm worried about the Fed pulling back, okay, and the effect of them pulling out of the market. I'm worried about higher taxes, which are almost certainly coming down, okay? And I'm worried about a possible China debt crisis, all right? Now, the Fed pulling back, okay, let me describe that a little bit more. The Fed has become far more interventionist in the market, okay, since 2008. Okay, since the initial debt crisis crash. Okay, the Fed invented this idea called quantitative easing, which is where they buy longer term securities and even longer term mortgage debt, driving down long-term interest rates, not just short-term interest rates, which has been their focus previous to the 2008 financial crisis. Okay, as they begin to unwind that quantitative easing, I'm worried that they'll either do it too fast or too slow. Because if they don't do it exactly right, as the market forces take over from the Fed controlling interest rates to the market controlling interest rates, their ability to pull back at just the right pace, giving the market decision-making power again. If they do it too fast or too slow, we'll see dramatic spikes or drops in interest rates. Okay, and that is really bad for bond portfolios, okay? So I'm a little worried about that. Higher taxes, okay? Higher taxes impact all of your financial stability, right? You know, the more money you have going out in taxes, the less you have money to spend, okay? And that concerns me big time, okay? I'm hyper-focused right now on long-term capital gains, okay? And I'm hyper-focused on estate taxes. Now, the good news is most of you still will not pay estate taxes if the total exemption is brought down to 5 million, okay? But some of you will, okay? And if we can avoid estate taxes, that's the best bang for your buck, dollar for dollar, okay? With long-term capital gains taxes possibly going up substantially, okay? We're looking at really having to dial down on the amount of trading we do and how we generate gains, okay? Because for most of you, we did tax loss harvesting right at the bottom of the coronavirus crash. You now have huge long-term capital gains, okay? That makes trading the portfolio that much more complicated going forward. It's not really a change in strategy, it's more of a hyper focus on how we control those taxes going forward for all of you, okay? So that's gonna be one of my big focuses going forward. And then the last kind of potential black swan type of event that what I'm worried about is a potential China debt crisis. Okay, we all got some bad news about Evergrande, the company in China that looks like they're not going to be able to make debt payments. It looks like the Chinese government's going to kind of step in and ease the burden of that. But the big fear is that this is going to be China's Lehman Brothers, okay, that there's going to be a contagion effect off of that, and that the debt crisis is going to expand from one company to the entire financial sector. And if China goes down like that, it will have a contagious effect globally. The Chinese government is infamous for being able to control things. So we just don't know. It's a black box, and that's why I really do consider it a black swan. So then what's my strategy going forward based on what I am worried about, okay? We used structured notes very successfully as part of our war chest strategy going all the way back to 2018. And I am looking at that as a possible strategy again, but this time not to protect the equity side of the portfolio. I'm looking at it to protect the bond side of the portfolio, because everything I'm worried about in the market, yes, it has an effect on equities, but it will also have a huge effect on bonds. And the bonds are there to protect you guys against what we know will be fluctuations in the equity markets, okay? And I'm comfortable with the idea that there will be fluctuations in the equity markets, but the bonds have to be there to provide the cash flow and the stability to the portfolio, okay? So I can't have the equity markets and the bond markets both dropping at the same time. So I'm looking at how do I secure the bond piece of the portfolio from from those potential problems. All right. And structured notes are a possibility to do that. And so we're looking at that very strongly again. We're going to continue to be flexible with the rebalancing that we do. All of you guys got a notice from us just this past week that we kind of jumped on this September drop to do some rebalancing. Periodic and opportunistic rebalancing is a great way to add a, some really good performance to the portfolio, keeping the returns up. It's kind of one of those ways where we're just able to add value on an ongoing basis. One big way that I'm looking to protect the portfolio is we're going to maintain our international diversification. This has been a struggle. I won't lie to you, okay? The US stock market has outperformed international stocks almost every single year for the last 10 years, okay? But the question isn't what did the best the last 10 years. The question is what's the right investment mix the next 10 years, okay? And I refuse to believe that the US is the only place there's going to be returns over the next 10 years and 20 years. And certainly our history, stock market history before just the last 10 years does show that and plays that out. And so I believe that for your protection and for the performance of the portfolio, we need to maintain international diversification. And I'm happy to talk through that and debate that with you guys if you have thoughts on it, because it's a sticky question, but I still believe it's the right thing to do for all of you. The other thing we're really going to focus on is minimizing your exposure to U.S. high-yield bonds or junk bonds, okay? The interest rates you're getting on high-yield bonds are just not that much higher than on high-quality bonds. And so it's a lot of extra risk to take on for just not much return. And I feel like we can get that much better using something like a structured note than the high yield, okay? And so we're going to be making those changes in the portfolio where we see our clients invested in the high yield space, which is if you have it at all, it's a pretty small part of the portfolio. All right, so that is my presentation. I think I came in even shorter than I thought, so coming in about 25 minutes. That's what we're going to be implementing going forward. We're going to be protecting the bond piece. I am expecting, I'll go ahead and stop sharing my screen, okay? I am expecting smaller than normal returns overall the next couple years. We are coming off of unusually high market performance. And so I think it would be perfectly normal to have a couple years of mid-single digit returns on the portfolio. So as I look forward to 2022 and 2023, I would not be surprised to see returns on your portfolios in the more like the 4, 5 to 6% range than the 7, 8, 9% that you guys have all been realizing the last 5 years. Okay, let's see. I'll go ahead and pause and open it up to anybody who has questions.
John?
Yeah, Greg. Okay. Or was that Greg or who was it?
Barry.
Barry. Hey, Barry.
My question may be just personal, so if it is, just tell me and we'll talk about it later. But is this a good time for us to, if we have still a lot of equity in our house, to maybe get a sort of refinancing?
Yeah, great question. So, previous to the last 2 weeks, interest rates were very low. Okay, now we did see interest rates spike up a bit the last couple weeks. I think it was about a 0.5% move in mortgage rates the last couple years. However, if your mortgage rate is still, certainly if it's above 4% or higher, you should absolutely look into refinancing. But even if it's in the high 3s, it could be worthwhile. It's still extremely difficult for self-employed borrowers to get financing. But if you have W-2 income, or you have steady retirement income coming from out of your portfolio or from Social Security, as most of my clients do, you can qualify for a refinance. As far as pulling cash out, Interest rates on cash out refinances are higher, but there are some strategies to do a cash out refinance and then wait 6 months and do a rate term refinance now to a lower rate. It's kind of like using 2 mortgages to get the best deal. But I'm happy to refer any of you guys to a mortgage broker who can kind of run through that with you.
Thanks, John.
John?
Yes.
John, I have a quick question here. You talked about your concern about long-term capital gains, I guess taxes on that, but isn't our portfolios, or maybe just mine, isn't that tax deferred? So it wouldn't be long-term capital gains we'd be talking about, we'd be talking about income taxes, right?
That's correct. So if your money is in a retirement account or any other qualified account, we're not worried about long-term capital gains on that. Every dollar that comes out is ordinary income. Many of you do have non-retirement investments, or you're pulling, because of required minimum distributions, you may be forced to pull more money out of your IRA than you otherwise need, in which case we may be reinvesting that in a non-retirement account, either under the name of a trust or jointly or individual. And that's where long-term capital gains really come into play. I'm also talking to a lot of you guys right now about possibly selling homes and moving out of state. And though most of you, thank goodness, will not pay long-term capital gains on the sale of a primary residence, some of you will, and it is a consideration.
Okay, next question I had was in the rebalancing you talked about. And it seems to me you're rebalancing into like emerging markets, ETFs. Isn't China part of that exposure? Don't you?
Not directly. Yeah, great question, Steve. Not directly. You guys don't have any direct China investments because there's just no real practical way to get into it through publicly traded securities. But there's no doubt about it. The Pacific Rim, is largely impacted by China, as is the rest of the world, right? So as we invest into the emerging markets, okay, so rebalancing is essentially a function of selling whatever has gone up and buying whatever has either dropped or has not gone up as much. Okay, so in the last rebalance we did, emerging markets is a small part of the portfolio, so the trade wasn't large. Okay, but we were buying emerging markets because, again, relative to the other investments, it had not gone up as much or had dropped a little bit in September. Emerging markets do tend to be a volatile part of the portfolio, and so it's hard to it's hard to tell exactly what we're going to do with something that volatile trade to trade. But I wouldn't look at that as some indication of like I'm playing the emerging markets going forward. It's just that when you rebalance periodically and you're disciplined about it, you're always relatively selling high and relatively buying low. And that's where the value comes from.
Okay. Okay. My third and final question was when you talked about the US debt, when you had that example of a mortgage, it's really a variable, right? It's not a fixed mortgage. Back in '94, it was 3 point something, and now it's 1.5, and next year it might be 4.5. So you really didn't talk about what the payment would be if it was at 4.5, right?
Sure. Yeah, you're absolutely right. You're absolutely right. But I think so even if it were at 4.5, in which case the interest payments would triple, right, compared to what they are now, compared to our gross domestic product, it's still a very small fraction. Okay, and so our country as a secure borrower, okay, and our ability to generate, and again, GDP is not exactly income. Okay, if you were really talking income, you'd be talking about tax revenue. Okay, but tax revenue is a direct function of GDP. Okay, the more GDP going on, the more taxes generated. Those tax rates are, of course, decided by the legislature and flow around like crazy. Okay, but still, it's still relevant to look at the tax expense. I'm sorry, the interest expense relative to GDP, because we're still an extremely strong borrower relative to the amount of debt we have. And that's kind of the point I was looking to make. Okay. But you're right. Yeah, those interest rates are variable. Yeah. Greg, do you have a question?
Yeah. I know you talk about U.S. debt, but on a slightly different angle. If Congress decides to default on debt, what long-term, short-term, long-term effect might that have on the market?
Sure. Great question. So I think I even put it in my email. I was hoping they would have resolved it by today. They did file the continuing resolution, right? So they kicked the can down the road another 2 weeks. I think it's October 18th. Okay, so it's not going to happen. Okay, the U.S. is not going to default on its debt. It's not going to happen. They'll get it figured out. Okay, but if it does happen, the Treasury, okay, is not going to stop making interest payments on the debt. Okay, the first thing they're going to stop doing is stop paying the bills for, employees in the U.S. government workers and all of those payments. They're going to continue making the U.S. debt payments until, I think Janet Yellen's current estimate is like it all runs out in February or something like that. I can't remember exactly, but the U.S. is not going to default on its debt. So if the Treasury is forced to stop making government payments to contractors and employees and Social Security, it could plunge us into a recession. Okay, and that I think would be the worst case scenario. We're not going to get to the point where we default on our debt. So I don't think any of that is going to happen. But yeah, the worst case scenario is that, the government has to stop spending money, and that seriously disrupts our economy and pushes us into a recession. In which case we don't know. In which case we don't know what the Fed will then do. The Fed has about a $9 trillion balance sheet. Could they go from 9 trillion to 18 trillion in an effort to offset our Congress acting like a bunch of imbeciles? I don't know. I don't know. Nobody knows. Okay. Any other questions? All right. Well, excellent. Well, this has been great. If you do have any questions that you didn't want to ask publicly, please go ahead and email them over to me, and I'm happy to reply to them. If you feel like you want to understand how any of what I've talked about today affects you specifically, I'm happy to get a meeting on the calendar. We can either meet in person or over Zoom. We are running full speed ahead over here, so happy to help any way I can. Let me know what questions you have. Let me know what you're thinking about, what you're worried about, and we'll work through it together. All right, everybody, we'll talk again soon. Thank you.